Hey everyone, thanks so much for joining us again for part two of the deep look into the Optuma Signal Tester. Now last week we had a look at an idea. We took two moving averages, we codified that, used the show bar to prove that we were happy with that, and then we brought it into the signal tester. Now, if you were paying attention last week, you would have noticed that we were talking about finding a flat period in the market, 10 years where the end of the market was the same at the start, same price, so that we take trend out of the situation there. But again, if you were paying attention, you would have noticed that we were starting at 2000, but when we went to the signal tester, I actually put in 2001. So I only spotted that when I watched the video back afterwards. So we fixed that up here, and I'll go through those stats in a moment. But an interesting thing, when I was driving home from the office late last week, I heard an interview from Michael Lewis. Now, Michael Lewis wrote The Big Short, Moneyball, and he's got a new book out, and they were interviewing him about that new book. But there was something that he said that I just thought was amazing. I just want you to have a listen to that right now.
And Michael Lewis has been studying research on the human mind for his latest book, The Undoing Project. It chronicles the lives of two men who made that discovery and many others about the surprising way humans make decisions. In fact, Amos Tversky and Daniel Kahneman founded an entire branch of psychology called behavioral economics. Michael Lewis's interest in these two psychologists came out of one of his other books, Moneyball, which was about trusting statistics instead of intuition to build a successful baseball team.
When the book was published, it was pointed out to me in a review that the mistakes that people make when they're judging other people had been described well by these two Israeli psychologists in work they'd done in the 1970s, and I was oblivious to it. This book, if anything, is like the prequel to Moneyball. It explains why experts' intuitive judgments can go wrong and why you need to have data to rely on as a check against the judgments of these experts.
I don't know about you, but I just found that interview absolutely amazing. That comment that he made that data was more important than the expert's intuition in what he found with the whole Moneyball book and film. That is really what's happening with us as well. There's so many times that, we have this intuition, we read about something, be it a technique or a tool, and we think, oh, well, this is how it's supposed to work. And so, yes, an RSI crossing below 30 is an oversold signal. So for a mean reversion, let's grab that as our signal. Well, we need to know, it's not just enough to look at a chart, look at a couple of charts, because you could get really lucky and just look at all the perfect examples. There's a whole study of psychology and framing and things like that where we can actually start seeing things and start seeing confirmations that actually don't exist. So these are all things that we've got to be aware of when we come to strategies like this, when we come to analysis. We do need to use our knowledge, we need to use our understanding when we set up a signal test or when we're looking for strategies to use. But we can't just rely on intuition and on gut feel and those sorts of things. And I don't know, maybe you, like me, you've met people who just seem to be these incredible traders and they do absolutely fantastic. I've got to say that after 21 odd years doing this, I've met quite a few people like that, but they don't last. The people that last in this industry, be it privately, be it working as a portfolio manager or an analyst or a trader, the people who last are the ones who have a very well-defined process, and they then have the discipline to follow their process. And so it's just really important that you can do this type of testing and have the confidence. Now, quick plug, if you want to know more about technical analysis, and like I keep saying, you have to have the understanding about what all these technical indicators are actually doing. I would strongly recommend the CMT program to anybody who really wants to dig in and get a much better understanding of that. So just go to mta.org and you can find more information about the CMT program there. All right, so let's have a look at our test that we did on our two moving averages. Now remember, as I said, that we have added in an extra year of data, so we were missing a year in the bull market. So it's pulled our results down a little bit, but not too bad, you know. So, and you kind of would expect that to a certain extent, because as the market rolls over, the faster moving average is going to be under, and we're not going to be getting many signals in that period. One thing I don't think I explained really well last week that I just want to touch on, you know, so we've got in the stats there, we've got our signal, we've got our index, and we've got the Monte Carlo. Every time we get a signal, what we're also doing is taking a measurement of the comparison index. So in this case, the SPX. So for now, it's gone from 8,500 to 9,100, nearly 9,200 signals here. For each one of those 9,200 signals, whatever day we get that signal, we take a reading on the S&P, and then we measure that over 6 months. And we measure those returns, and all of those then get averaged up. And that's how that orange line is created on our chart. The reason we do that is we want to know that our strategy is giving us lift over a completely unmanaged index fund that we could have been using as well. And again, so that's why we see that. That's why this red line's important, because that's our alpha over the index for each one of those periods. And again, we have all of those same stats here. So again, for the probability of gain, if we just took the index, et cetera, and then down to the mean and median return. This one's interesting actually, because in the index, we have a mean return of 1.8%, but a median of 4%, meaning that there were some pretty big losses there, which were pulling the numbers down. So very interesting there as well. 80th percentile, etc. All those same sort of numbers there. They're really good as a comparison. You want to be doing better than just the index there. So the next thing that we want to talk about then is the Monte Carlo. Now this one's really important, because basically the Monte Carlo is our simulation of what would happen in real life. So where this all came from is Monte Carlo. It's kind of like a casino style technique of being able to simulate what the possibilities and the probabilities are. So, you know, we've got a whole blog on that at our blog at optuma.com/blog. You can check that out on Monte Carlo. But what's really important to know is that out of all those signals, so those 9,200 signals that we have from our test, what we're doing in this case is that we're going to pick 10 of those signals and then compound the returns. Now that is just one test. And then we run that same test, I think it's 20,000 times we're doing that here. So basically, that allows us to then create a new plot. You can see the blue plot here on the chart. It allows us to then simulate, well, if we did this 10 times in a row, how are we going to do? Now, what I want to see when I'm doing a Monte Carlo is I want to see an increase in probability of gain. I want to know that if I keep using my strategy again and again and again, I'm actually increasing my odds of being profitable. And there are situations where you'll find that it actually decreases. That's an alarm bell. I want to get out. I don't want to work with a strategy that is going that way. The other thing I'm looking for is obviously better average return, better median return. I'm expecting standard deviation to get bigger. Because if I get 10 winners in a row, well, I could be up 2,000%. And so, you know, the spread's getting a bit wider there on that situation as well. Now, the other thing I try to do with Monte Carlo, And you can see here, I've got it set to 10 at the moment. What I like to do is try and get it around a year. So for instance, this is a 6-month test. So I want to set this to 2. So let's just go do that now. I'm just going to change that to 2, and you can see immediately it updates. Now that's reduced a lot of the numbers on my stats there for the Monte Carlo. You know, my probability is only, 0.5% higher than what it was before. My mean is a little more than double, which is good. So the compounding of that is giving me better returns. So you can see that. So I've now got this, my mean return, my median return, I can look at those and say, well, these are really good proxies for an annual return based on this strategy with a 6-month hold time. And so that's how, I like to use that. If I was doing a monthly test, so, we'll do one in a minute, which is a monthly test, then I'd be doing 12 tests because I want to compound 12 together. The beauty is with Monte Carlo is that we're completely doing this by random. We are just picking signals at random and bringing them together and working it out that way. By having such a high level of randomness, we're not picking a path. You see, one of the real problems with backtesting, and I talked about this before, that I'd explained why backtesting is so bad. I shouldn't say so bad, sorry. Where there are some real pitfalls that you must understand if you ever do any backtesting. The way I like to imagine all of these signals is almost like tiles or stepping stones on a floor. And so each one of those is a signal. Now, when I do a backtest, because of the limitations that we talked about last week of capital sizing, position sizing, pyramiding, stops, losses, all those sorts of things, I can't take every single signal in my backtest. So what I'm doing is I'm stepping over there on that stone, and then I'm stepping on that stone, and I'm stepping on that stone, and I'm picking a path through all of those signals and coming up with a number at the end. And I hope by now that what you can see is, if I look at that annual rate of return from a backtest and say, oh, this is a great signal or this is a bad signal because this is what the annual rate of return was, that is just so fraught with problems. There is just not enough information that has gone into that number. We have to be a lot more diligent about considering all of the possible scenarios and including them in our calculation. I just can't stress this enough because I just see so many people who just look at a backtest and they're either adopting strategies purely on the backtest or disregarding possibly good strategies purely on the backtest. And then talking about annual rate of return when they haven't considered all of the information. Critically important. As I said, I just can't stress that enough. So the real thing that we have to do when we're doing this, and I don't want to say that backtesting doesn't have its place. You see, once signal testing is done, and I know, I've got a good signal here, and I can see the time. Now, for instance, on this curve, it's not so obvious, but if we have a look here, we've got the market going up, nice slope. Then around here, which is how many days? It's 30 days in, the slope starts to drop off a little bit. Well, this is great because I can look at that and say, you know what? I kind of think, actually, I've just spotted a better, even better situation. Have a look at the red line. This is our alpha over the index. It's going up, and then starts to go down. So, if I'm concerned about alpha over the index, then at 91 days, 91 trading periods, be around 4 months, 4.5 months, that is a peak on a relative basis. So if I was looking then at this and saying, okay, I'm going to take these signals, I'm going to hold them for a predefined amount of time, well then 91 days would be as long as I would hold them because my quantitative analysis is telling me that that's on average where the peak happens and I start my alpha starts reducing after that. So again, it's these things. Now, armed with that knowledge, I can then take that into the backtester and I can put a time stop in. I can put in some other stops, some other rules, position sizing. I know how long I'm going to stay in a position. And so I've got a really good idea how to set up my position sizing. See, all of this makes my backtesting even that much more valid rather than skipping this step with the signal tester here. All right, so a couple other things. Well, speaking about stops, I mean, what effect would a stop have? You know, if we look at the profit analysis here, we can see that we had some really bad losses down at negative 100%. So we may sit here and say, well, you know what if my 20th percentile was at nearly 11%, what if I put a stop in at, let's say, 15%? Well, the signal tester lets us simulate that. So we can come along here now and let's just put in a 15% stop, hit enter on that. It's going to reprocess all of those signals. And as you would expect, there is a massive spike. We've had a lot of trades which stopped out at 15%. So what's our probability of gain? Well, it's gone down. It's gone down from 61% to 55%. Our mean return is pretty much the same, but our median is much, much worse. And so slight reduction in standard deviation. Instead of a 2-to-1 on reward to risk, I'm probably running maybe a 1.25 to 1. So I've reduced my reward to risk. I have reduced my median gain. Mean, as said, is pretty similar. It hasn't actually done what I want. And again, this is why this is so important, because we have to understand what effect a stop has on our strategy. Now, depending on your strategy, will depend on whether it's a tight stop, whether it's a loose stop. Now, I'm not saying that stops aren't important. They have their place. But with every strategy, where you put your stop is different. And so we do the math. Now, even looking here at the Monte Carlo, which looks quite truncated, you know, so many losses there. You know, it's really reduced the numbers. Let me just see if I can scale this. No, it won't let me. So we've got that there, and looking at the stats, you know, still small improvement. Actually, let me go to 10. I think 10 would be better for Monte Carlo. So I'm just going to go 10. There we go. That's better. And the reason why I wanted to do that is because experience of having done this, I knew that I should be seeing what we're seeing now. The Monte Carlo now has a probability gain of 72%. So we're almost 10% higher than where we were without the stop. Our mean return 79, our reward to risk, again, got to do some quick math, 10-to-1. So not all that much better, but still significant there. What's happening and why is our Monte Carlo showing such a better mean return? And basically we've truncated our losses. You know, we've hit the losses, we've stopped them early, and we've been able to, when we compound our returns, those losses, even though there's more of them, when we're going back 10 times in a row and doing the Monte Carlo, well, statistically, this is telling us that we are actually going to do better. So in effect, if I was taking just one trade, this would be saying to me, no, the stop is actually hurting your returns. But when I go back again and again and again, this is showing me the actual benefit that having the stop will have. I actually got asked a question a little while ago about targets and whether, you know, we should use price targets. Well, we can do the same sort of thing, you know. So if we said that, you know, the average return, mean return was 6%, so if I could get 15%, that'd be great. So let's then, and you know, we want to stop out. As soon as we get that 15%, we're out of the trade. So let me just set this one back to 0. I've got to let that run and refresh. And now let's come along here and set a target for 15%. So what we've got, we've increased our probability of gain. So obviously by going from 61 up to 67 meant that there were a number of these signals that started off well and then dropped. And again, moving average signals, think about it. Fast moving average crossing a slow, the market's in an uptrend. We would expect to be doing well there. And then, obviously they started up and then they came back down and made a loss. Well, those were cut off at a 15% gain rather than carrying that all the way through. Have a look at the main plot. Have a look where our profit is on the signal. We're sitting now at, for a median, at 12.27%. Our mean is less, but our median is doing really, really well with this one. So, from a single trade perspective, that target makes a lot of sense. But again, now let's look at the Monte Carlo. And so you can see that our probability of gain has now dropped to 63%. We're getting a fatter distribution. I can't remember if I mentioned this last week or not, but whenever we look at these distributions, we like to see a high and tight distribution, because that means there's a lot of certainty around that average. When it's low and wide, that means that, yeah, we may have the same average, but there's so much more variance around that average. The standard deviation is so much higher. I've got so much less confidence that I'm going to be landing somewhere near that average. So remember, high and tight's good, low and fat, not so good at all. So yeah, the Monte Carlo showing us that the targets in the long term, when you are making multiple trades, may not be the best thing for you. Now, you could play with those numbers and you could set them, and maybe there's a number, 25, 30, 40%, where it makes sense to pick up a target. And same with stops, But again, the signal tester lets us look at that and say, what effect do those have on our strategy there? All right, so we have three other things. We're going to try and get through these pretty quickly. There is grouping in here. Now you can group by anything. So we could group by sector, we could group by year. Maybe what we'll do is let's just group by year, and I'm just going to run that test again. Still should only take 8 seconds or so. So by grouping by year, what we are doing is saying, let me just look at each year individually. And that way on the one plot, I can just look at those results and see what's going on. So we've got a couple here. What's that? 2010. Of course, that's because my data stopped. I stopped my data before that. Oh no, hang on. No, I've got my target still on. So you can see the target clipping all of those off at 15%. So let me go and turn that off. And we can run that again. There we go. Now we've got all of the different years viewed, so we can see 2008. And if I hover over that, the orange line again is my index, the red line is the alpha. So we can see how we performed with our strategy against the index for each one of these years. And as I said, you can group by anything. So be it sector, be it one of the fundamental fields, and just work that way. So very handy. I'm going to take grouping off just for a moment because there's another thing that I want to show you quickly. Let's just run this again. While that's really nice looking at that, and you can look at the different years, the other thing that I like to do is actually just focus in, because that was quite messy seeing all the years there. Now, if you've used Optuma, you recognize what we call the history slider at the top. It allows, on a normal bar chart, for instance, you can scroll back and forwards and you can see a little representation at the top of the chart there. Well, if we look at this one here, you can see all the white spikes in there. That's giving me an indication of how many signals happen at each period in time. So if I see a lot of signals around March 2009, then I know that my test is being weighted too much to that one event. I want to see, when I look at that blue bar, I want to see a nice distribution of signals, because that means that my strategy is going to be producing trades for me on a consistent basis. So again, that's why that's very, very important. But let's just say, well, I wanted to see what happened in 2007. Well, I just click on 2007 and the signal tester now processes only the signals from that year. And so we can look at, oh, gee, our test was down 3.3%, market was down 5.5%, so we've got an alpha of 2.2. And we can look at the stats there, or we can look at 2008 and say, okay, well, when it really started going down, what happened? Again, we're running a couple of percentage points above what the index was doing at the same time. So, not too bad. That's we're showing some improvement there. And then we can go 2009 and etc. We can go through all of these and have a look. And, so sitting here in 2009, we actually underperformed the market as it rose up. Still had, nearly 18% median, 24% mean, but we didn't do as well as the benchmark there. And again, think about it. It's a 2 moving average strategy. We kind of would expect that. We're going to be later to the party because of the inherent lag that a moving average has in its calculation. I can just double click up here and it'll go back to being the whole list there. There's another important thing to consider. Whenever you're doing quantitative testing, there's a term called stratification. And we've got this setting here in the signal tester. So like I was just saying before, if all of my signals, or if my strategy was one where in March 2009, I got, let's say 500 signals come through, but on a normal month, I may only get 40 signals, then that event is skewing my results. Again, it's like we said, I think last time, that we want to do everything to dial down our results. We want to be as pessimistic and as brutal as possible when we set up these strategies. Because if I'm going to take this to market, I want surprises on the pleasant, happy, profitable side, rather than the loss side where clients come chasing me because of that. So what I want to be able to do is really pare back and have consistent, and it may even be that because of the mandates of my portfolio, because of the capital that I have available, or limits on how much I can turn over, that I can only take 40 positions a month anyway. There may be 10 trades a week and that's it. So what I can do is we can come in here to stratification, and I'm going to set that to monthly, meaning that I want to have a monthly limit. It's set to 50 there, but let's just use the example of 40. So I'm going to set that to 40, and let's hit test signal now. And as you would expect, it's going to change my results. So it works very similar to Monte Carlo, where if there were 200 signals in a month, it's going to randomly pick them. Now, this is almost contradicting what I said before about needing to examine every single signal. Because now suddenly I'm telling you, oh, use stratification and ignore a group of the signals. I still will say to you, have stratification turned off and do your testing first with every signal. You want to know, how does this type of signal work in general? Now what we're trying to do is get a little more down into, okay, let's make this a little more realistic. I couldn't take 200 signals. What would happen if I just randomly picked 50? And so, that's what's happening here. And again, we can look at those numbers. It's pared back my returns a little bit, so it's actually proving to me that I probably had too many signals around really, really nice periods in the market. And that was skewing my results a little bit. So we've been able to do that. We can see here the same stats, 61% gain still, 5.5% mean, just 4.7% median. So again, 2 to 1 on reward to risk, this is actually a nice, robust system for a long trade like that. You know, one more thing I would just sort of point out. Again, if we look at the main plot here, you can see just the flat lines. You know, it takes quite a few periods, what we're talking about, 6, 7, you know, we're talking about a week and a half of trading days before this signal gives us, you know, any profit at all. So this is a long-term signal that we're working on, and I think we're probably running out of time in this session again. So there's going to be a part 3 on signal testing, and next week what we're going to do is just focus on a number of examples. You know, so there's been a lot of talking about the signal tester. Next week I want to take you through probably about 3 examples from idea all the way through to testing it and having a look at those results there. One final thing that I'd like to cover just today, and that is the actual report. So what we can do here, you know, we've got report options in the signal testing, and this is really important. You're running a portfolio manager, you're creating a strategy, and you want to explain to your clients or your family, if your family is your clients. Dangerous situation, that one. But you want to be able to create something and sort of communicate to them, hey, this is the strategy, here's how it works. You know, for instance, on the Monte Carlo, actually, we can switch from a distribution to a win-loss ratio. And it's telling me the number of times, when I did those 10 trades in a row, how many times did I get 10 winners in a row, 10 losers, etc. And I can look at this and say, you know what, my ratio of -6, meaning that I would have had 2 winners and 8 losers. Had to do the math quickly in my head there. That only happened 172 times. So when you're in that situation of you're executing your strategy and suddenly, you know, you're in this position where you've had 5 traders in a 5 losers in a row, well, you know what the probabilities are, and you can say to your clients, yes, we're in a downward trend, we're going to hold the strategy because this is what our quantitative testing has shown us, that yes, these events can happen, but they're quite rare, you know. So at a percentage point, that situation there at 6, you know, it's less than 1% of the time that can happen. And so it's good to have that and to have those tools to communicate. So we can come along here and we've got the ability for you to add notes. So I can say here, not mean reversion, trend following, and I could write notes about why I like this strategy and things like that there. I can talk about different things. I can talk about the returns commentary. So the description at the top would talk about this is the type of strategy that we're employing. And then the distribution, the returns, I can talk about the returns. I may want to mention that we're peaking in alpha after 91 days. In this strategy, you know, etc. So then we can talk about the distribution, which is, remember, there's that blue bar at the top. What's the distribution of trades? You know, I can make comments on that or leave them blank. Monte Carlo, etc. I can choose to include the script. You can set the color, and you'll see that in a moment, and you can choose your own logo, so it's your company logo on the report. And then we can generate the report. I'm just going to save that. And here's how the report's presented. So this is that color that we chose. It's the name of our signal test on SP500 data by me. It's giving me what we would deem the most important numbers, the probability of gain every time we enter the market, 61%, median return, what that relates to on an annual basis. The script is included there or not, if you want to keep that. We've got the main plot produced, the distribution, and if I had comments for these, they would have shown up there. And then all the different plots, the stats for the signal and the 2 plots for the signal, the stats for the Monte Carlo, and the 3 charts for the Monte Carlo. Again, just all been created to help you in communicating these ideas. You know, or maybe you just want to put them on the shelf and say, hey, this was a really good idea. Let me print it out, put it on the shelf, and I'll come back to that in the future when I'm ready to create a new portfolio or something like that. As I said, we've gone way over time again, so we're going to do part 3 next week. We're going to do a lot more practical examples, and I'll show you some of the tests that we're working on here at Optuma. Thank you so much for taking the time. If you've got any questions about the Signal Tester, please don't hesitate to email us, support@optuma.com, and one of our specialists will get back to you on that. Or if you've got any suggestions on ways that we can help as well, please do let us know. Thank you again so much, and we'll see you next week.